It's do or die for the markets right here, right now. And while that may seem a little bit dramatic, we are headed into the first week of major tech earnings with the NASDAQ weakness still very much so in play, and the S&P quite literally sitting on its key level as of Friday's close. Oh, and let's not forget, PCE inflation numbers also come out this upcoming Friday. So welcome to the Trade Brigade Weekend Update. My name is Matt, and I want to show you today all of the data points that I'll be using to navigate this key juncture. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, solid red-bodied bar with a little bit of an upper wick, but we should certainly read into this upper wick because notice, on the bar-to-bar count, and I get it, we're getting ahead of ourselves in terms of location, we do produce a higher high, which is an all-time high breakout attempt, and that promptly fails. We find ourselves back down underneath the opening print. On the daily time frame chart, we'll see a decent-sized gap down. There's range expansion in the downward direction, and the sellers close fairly weak at the bottom end of the range here. There's really no buy-side response because we can clearly see there's no lower wick. So with that sort of understanding, I would say structurally sellers are in the driver's seat. And if we were to finish up location on the bar-to-bar count, we do also get a lower low and a more severe close completely outside of and below the prior week's range. So sellers go 2 for 2 on the weekly count. But this is sort of isolated to a 2-bar view up here towards the top end of what I would argue is a weekly uptrend. If we're thinking about the count, we have lows, higher lows, and these are just soft higher lows on the weekly time frame because on the daily time frame chart, we never actually drifted into a daily downtrend in the 2-week balance range. And we're currently pulling back from the highest high in the trend count, and what I would argue is that there are 3 locations here where the weekly time frame could produce a higher low and preserve the overall uptrend that we're in. As we described in last week's episode, we had talked about the top end of the 2-week balance range. If we could find buyers here and rotate back in the upward direction, this is really nothing more than healthy bull flag consolidation at the top end of a weekly uptrend, pulling back from the highest high in the trend count. If we were to go a little bit further than that, it's also okay to test and repair the soft higher lows on the weekly. And if I were to start giving you numbers, by the way, the first zone, the top end of the balance, we'll see this with some more detail on the daily chart in just a moment too, but it's 549.50, treat it as a zone down to about 547. The next location, the soft higher lows here, are around 541 to 542. You could also get a weekly higher low that looks something like this, and I would start trading that back in the upward direction towards the all-time highs. The last location might be deeper than we'd ideally like, but it's still okay, and I'll show you why in the trend count in just a second, is 531. If the market were to pull all the way back down to that level and see a rebound off of it back up towards these equal highs, then would the trend count on the weekly not still be lows? Higher lows, and this would count as a higher low. And the logic and the justification behind this is the fact that this is just a soft higher low, and we didn't really produce that daily downtrend, right? So 531, 541 to 542, then 547 up to 549.50. Are we getting confluence from a Fibonacci perspective? We absolutely are if we do something that looks like this. The 38.2 is here, closer to the bottom end of that zone, but 547.25. And based on the market profile, we'll also see that a majority of the value area in the 2-week balance range is still underneath us. We have not broken down through that zone yet. So this does strike me as bullish. And once again, we're on the lookout basically for a higher low on the weekly to form around this zone. If that doesn't happen, then fine, we have some other levels to pay attention to, but the trend here is still certainly up. We're going to get additional confluence if we bring out the weekly anchored VWAPs. Notice that probably as soon as this week, it's going to be right there around that 547.25. So liking that as well. If we bring out the volume profile, and we can drop this down to a much shorter time duration, something like 6 months will do, and we'll get rid of the fibs, bring this down a little bit. What I want to illustrate here is exactly the confluence from a volume at price perspective. This high volume node is the top end of the 2-week balance range. This high volume node is the bottom end of the 2-week balance range. If we were to rotate through the low volume void, the pullback brings you where? into the breakout point, and these are the three key levels that we were just describing. So I'm liking what I'm seeing. I still see the opportunity on the higher time frames for a reasonable pullback to yield a higher low, and then looking for trend continuation in the upward direction when we can spot a smaller time frame beginning phase of a reversal back for upside. On the daily time frame chart, we'll firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 557.50, implying a lower high. If we're contained by the lower bound of the expected move, the number is at 540.30. I would argue this is implying a lower low. Notice that it is confluence with the previous CPI gap up top side. It's also confluence, or it will be confluence early on in the week, with the daily 50 SMA. That's the blue moving average on my screen here. As we're thinking about what this suggests from a trend point of view, it's technically more bearish, suggesting the beginning stages of a possible daily downtrend, lower high, lower low. If we think about the trend that's in force, though, not the suggestion from the expected move, I would argue we're still in a daily uptrend, but only by a hair. We're pulling back from the highest high, and just like the weekly time frame chart, I would argue that these were soft higher lows on the daily. This is your last major set of firm higher lows because we did accomplish an hourly downtrend here. There was no hourly downtrend in that singular red-bodied bar, right? We were technically coming from a higher high, but we did make a lower low, more so neutral. So if this is your last higher low on the daily time frame chart, then ideally the next higher low is over the top end of the 2-week balance range. Any surprises here? Absolutely not. This is what we just described on the weekly, in between 549.50 and 547. You can start to see how, as we mentioned, a bulk of the value from that consolidation range is actually underneath 547, and we did not puncture underneath that area yet. Now, that brings me to my next point, which is just that the market structure here needs to sort of be acknowledged as a shift in tone from participants, right? We had gone from a regime that was just momentum buyers and dip buyers stepping up into those all-time highs to suddenly now we either have some aggressive profit takers or an attempt for momentum sellers to start stepping up here in the marketplace. I mean, Thursday and Friday's bar were pretty severe range expansion to the downside, both of them closing underneath last week's lower edge of the expected move. So as of right now, we're not seeing evidence of dip buyers stepping up towards this zone, but it doesn't mean we just throw in the towel because the trend here is still technically up. Now, an ideal way for this to play out would be that we test early on in the week, something like 547. Then on the hourly chart, perhaps there's a Brigade bolt over 549.50. And my major target would be up here on the retest of the 3-day balance lows and basically Wednesday's low as well, before that sort of acceleration to the downside, if you will. It's the upper edge of this week's expected move. A lot of confluence here. The structure makes sense as well. That's at 557.50. Now, I also want to sort of acknowledge that is there at least a threat there for a lower high? Absolutely, right? This is sort of what we talked about from the expected move analysis. There's a possibility that you set a lower high and now suddenly makes much more sense that the weekly trend could see more of that aggressive breakdown into the higher low zone we were referencing around 532.50, 531 was what we talked about on the weekly, right? So that's how I could sort of see that happening. And this is very, very speculative as of right now. Total speculation here. Ideally, it would just be great. We test this area. We get some sort of, so let's just draw this in total. We get some sort of flag consolidation up here that holds over 554.50, the low of Monday from 2 weeks ago now. And then we get a break from that flag back up to the all-time highs. The trend remains up. Everybody's, jumping for joy. It's fine and dandy, right? Rainbows and butterflies for everybody. So that's what the buyers want to see, is this situation right here. If the market extends itself early on in the week deeper into, I should say, the balance range from back here, more so into the value chunk that we were just describing, then I would argue that the threat is that this now suddenly emerges as what? Here's your head and shoulders. That is a daily reversal pattern. Any lower highs underneath 549.50 really become dangerous. This is going to turn into a massive flush point, and the CPI gap close is likely a minimal target, if not a deeper weekly pullback into that line in the sand we were just talking about at 532.50. So my take is that we don't have dip buyers stepping up yet. I'm keeping an open mind because the daily trend is still technically up. We know what we would like to see in the upward direction, ideally something that looks like this. An alternate path up here would be a daily trend reversal off of a lower high. That, of course, would be bearish. And if the bears push for this kind of lower high here builds out a nasty flush point for this that we had just mentioned. So that's your quick summary recap on the daily. Let's bring it on down to an hourly time frame chart. Let's get even more granular here. And let's see what's going on. So you can certainly see how this perhaps is now all overhead supply. We are certainly underneath this area here. So on the hourly time frame chart, we might take a slightly different approach where if you can spot the risk reward here for the Brigade Bolt, your first target might just be to this area, right? And that would be at 554.50 on the hourly chart. So now we're talking about intraday operators, right? You would probably look for something to back off of that. Maybe the right side of the V becomes a trade, and that's how we accomplish the target from the daily at 557.50. That would be the sort of ideal sequence for the buyers here if we were going to get something that was structurally sound underneath us. Now, this is just a higher low double bottom, but it could also emerge as an inverted head and shoulders, something that looks like this. Here it is, right? You could also get something that looks like this, which is more of like an equal low double bottom, then over your neckline. Gets interesting to the upside. Those are the ideas that I would be thinking about. Now, why on the hourly chart are we considering this? Because the hourly trend is technically down here. You have highs, lower highs, lows, lower highs, lower lows. You can count them on the way down. We're sitting on the lowest low of the cycle, so any sort of lower high attempt just keeps the hourly trend in the downward direction. You can see how the market's much more of a steady trend to the downside, something like a 15-minute trend there to the downside, versus the more sort of emotional breakdown that we saw on the early stages of that Thursday morning session. So this to me is a primary hourly target at 554.50. If the market's going to move in the downward direction, any consolidation here really builds out something like a bear flag, of course, and then underneath the lows, we're just targeting the bottom end of the daily range at 543.20. Any sort of lower highs beyond that become the head and shoulders that we were just describing if we get the lower high here underneath 549.50. So that's really the name of the game in terms of the pathing options that I would be looking out for. My primary thesis would be the Brigade Bolt. I'm leaning on this because the weekly trend is technically up, the daily trend is technically up. We had great confluence out of the weekly in terms of the Fibonacci's and the anchored VWAP. What do we see here on the hourly? Let's come in from the Wednesday gap down high, which was a partial gap close, right? Notice what we have here. Any sort of rejections of that 554.50 we were just referencing keeps us below the 61.8. Remember that if you're over a 61.8, the odds of a 100% retracement dramatically increase. So if we're below that, this should sort of be off the table as a potential target back up to the Wednesday high, or even attempting this gap that remains unfilled. If we're thinking about the anchored VWAPs intraday, let's see if we're getting any confluence out of this, and the answer is yes, right? As of right now, this is trying to act as confluence near that 549.50. This is from the CPI gap in the prior cycle. If we could support over this, if the market can Brigade Bolt above, great. We're holding on to that anchored VWAP. That does strike me as supportive of the daily higher low thesis that we've been outlining so far. Once again, on the hourly chart, notice that this now acts as potential resistance at 554.50. So we're almost stuck between a rock and a hard place here, but not to the degree where trades can't unfold. I think there's plenty of opportunity around these key levels we've identified so far. The last Fibonacci will come in from the lows up to the highs, just to sort of talk about the 61.8. We're technically underneath it. We can't sort of fudge that one. That one is what it is. We are underneath the 61.8. That means the odds of the 100% retracement to the downside are technically increased here. So your bear flag consolidation that cannot get in gear over 549.50 probably does yield a move towards the bottom end of the original balance from back over here. I just realized that we skipped out on the daily trend channel, so we're going to go back over to this and just evaluate where we're at in relationship to these areas. Let's bring this on up, and lo and behold, we are coming into the the bottom end of the trend channel here. We know that it was going to at some point offer confluence with the top end of the range. So if you're looking for more bullish evidence, I would actually argue that the location here is probably more advantageous, even if it's just for a counter trend move, right? More advantageous for a long and not so much chasing this thing short on the lows. We call that the sucker's short, right? Being dead short on the lows really sets you up for getting wicked out of the market on any sort of counter trend. Not really a great location there. Let's finish it up with the 20 SMA. We checked in on this on Wednesday it was, And notice on Friday we break down a little bit more severely underneath. So that would be a carry forward there that we've lost the daily 20 SMA in the S&P 500. Going on over to the market internals, this is always supporting evidence exhibit A for the S&P. Check out the video tutorial in the top right-hand corner if you're not familiar. A couple of things that I want to highlight here is the Thursday expansion of range. That was really the more severe down day, right? Notice that volume outflows are substantial. The advanced decline line closes in trend lower zone. The intraday index score is severely, red there. That's definitely a day you do not want to try to buy the dip on. And if we look at the cumulative build, it's the first time in a while we've actually seen this thing get past 5,000. For a long while, we've just been sort of stuck 2,000, 3,000, nothing really impressive. So substantial selling pressure. And it's not like, here's the most important part about this, right? It's not like we saw a liquidation break and that was it off of the open. If that was the case, you'd likely see a cumulative build that looked like this and then was flat or maybe even coming back towards zero into the afternoon. It was sustained selling pressure through the duration of the day, as was the index score getting worse and worse and worse. So when I acknowledge in the Wednesday update and say, hey guys, like way more damage has been done to this market, Thursday also reaffirms that point, and we want to be mindful of, probably striking a balance between still really leaning into that daily higher low opportunity with also sort of, hey, sellers are coming out of the woodwork and we can see that at the exchange level. It's not just like what we saw on the Thursday session of 2 weeks ago where it was only heavyweight tech selling off. On Thursday this week, it was more so widespread and systematic across the exchange level. Let's finish up the ES side of things with the market profile. If you're not familiar with this is always Exhibit B. Check out the video tutorial in the top right-hand corner. And I just want to reaffirm what we talked about on the weekly, on the daily, with a chunk, or I should say a majority, of the value actually existing underneath what is technically the top end of the 2-week range. You had highs, but look at where all these points of controls are. The little green/yellow dashes on the screen are all contained within this box. So as long as we're above that, I wouldn't throw in the towel. On the long side, I would be thinking about, can we operate as daily higher low pullback buyers? If we zoom in a little bit more so on the more recent market profiles, I do also, again, want to acknowledge the selling pressure with the fact that you have value here. Value is clean to the downside. Value, it's not quite clean. There's a little bit of overlap on the Friday session, but the point of control is definitively migrating in the downward direction would be an indication to me that the sellers are really putting the pedal to the metal here. It's not like we have some consolidation, then a liquidation break where just a handful of sellers are participating. No, this is a nice steady grind, if you will, in the downward direction. The final thing here on the market profile is twofold maybe. Notice that on Friday, we could not get into sort of the upper distribution. There's a small string of single prints in D period here that separate an upper from a lower. No love in the upper distribution whatsoever. And we also have a poor low on Friday's session. What does that mean? Wouldn't be unreasonable for that area to be broken, see that repaired, and this is the key. This is the key, right? What do we know is underneath us? We just showed you all the value off to the left. This is the Brigade bolt. If you can repair the poor structure, the improper end of the auction from the Friday session, then get a higher low back in range, that's where I would look to be long, even if it's just for a counter trend move. I want to reiterate that fact one more time because of what we just saw out of the market internals. I would still take this as a trade 10 out of 10 times, even if it's just, we're not overstaying our welcome. It's not like we're targeting the all-time highs. Just one reference point at a time. That is a solid looking long because of the structure here that Friday had left behind. With that said, let's jump on over now into the NASDAQ. So here we've got the QQQs on the weekly time frame chart. What do we see in terms of candle structure and location? This one's going to be similar, yet somewhat different to the S&P. So in terms of structure, it's identical. Solid red-bodied bar, a little bit of an upper wick. But in terms of location, here's the difference, right? Obviously, we did not attempt a new higher high, so no all-time high breakout failure. But it's also different in the sense that we have a lower high and a lower low, but it doesn't just engulf the previous week's range. It actually closes underneath the prior week's range. So much more of a bearish engulfment here out of the QQQ NASDAQ. I would argue sellers are much more firmly in control, and this should not come as a surprise based on all of our discussions so far, throughout the duration of last week, when we were identifying that the Magnificent Seven basically were falling off of a cliff. Now, the weekly structure here is still in an uptrend. You have lows from way back here, higher lows, soft higher lows, just like we described on the S&P. You had highs, higher highs, higher higher highs. We're pulling back from the highest high in the trend sequence. So as we potentially drop here underneath 475, what's the next, retest level? It would be here at 460. I would still make the argument that from here to here is a higher low, and just like the S&P, even if the NASDAQ continues to the downside, you could still yield an opportunity for a weekly higher low to preserve the uptrend that we're in. And of course, we'll acknowledge there's then going to be the opportunity for a lower high threat. The pullback is deeper than what we might want to see here, but that, as of right now, is the primary thesis out of the weekly, and this level down here is at 460 if we were to travel through this thin structure retracement. Any confluence out of these levels, and also, quite clearly as well, there was no attempt for a buy-side reaction off the top end of the 2-week balance range. Let's come in here with the Fibonacci, see if we're getting any confluence from multiple perspectives from here to here. 50% retracement on the retest at 460, not really that great. If we come in from the hammer low up to the all-time high, we are underneath the 38.2. That was still stuck in no man's land. That really did not provide confluence with anything. The 61.8 is also north of the 460, so not liking the Fibonacci's out of the QQQ at this point. Remember that structure always rules all. What do we see out of the anchored view apps right here, right now? So as we said in the intro, it is do or die for the QQQ. In a picture perfect world, yeah, the soft higher lows would act as support here at 475. Let's take it on down. Well, firstly, let's be congruent. Let's finish up with the volume profile. And then we'll take it on down to the daily, and I'll show you exactly what my concerns and watches will be out of the NASDAQ side of things. So here we can see that the high volume node has been closed underneath. The low volume void brings you where? To that retest zone we were just talking about. Once again, this is about a 15-point rotation underneath 475 into 460. If we see a turnaround, this is, I would argue, more bullish than bearish. It falls back into that category of like, okay, just consolidation, bull flag consolidation from this perspective likely at the all-time highs in the NASDAQ. Now, let's get more granular. Let's talk about exactly how the pathing options will start to unfold based on the daily chart first. So, weekly expected move. What do we see here? This is the range. If we're contained, we certainly have a lower high opportunity up against 486.75, and you've also got a lower low opportunity way down here at 465, technically over the weekly higher low level we were just referencing at 460. If you want to be precise, it's 459.50. So expected move strikes me as being bearish. Now, what do we see on the daily time frame chart already? We're already at the equal low basically, and there was no attempt whatsoever on Wednesday for any side, sort of buy side reaction off the top of the range, 486.75. So as of right now, lower highs yield a downtrend. You have highs, lows, big time lower lows. Another lower high is fine, setting up quite clearly. I think everybody can agree on this one. There's your Man Ray pattern. And anything underneath that neckline, 475.35, opens the door for the CPI gap. That would be a loss of the daily 50 SMA as well. Anything beyond that, we're really scouting that weekly higher low zone at 459.50. So I don't really see a rainbows and butterflies situation for the NASDAQ until on the daily time frame chart, there's some sort of higher low back over this inflection point at 486.75. Upper edge of the weekly expected move is off by a penny, which is why this looks funny on the screen, but 486.75. If you're looking for longs, if you're looking for this gap to close overhead from Wednesday, it's got to be on a higher low, recapturing 486.75. If we're thinking about the candle structure like we did in the S&P, it's worth acknowledging the change in tone. Is there any sort of buy-side reaction on Wednesday's gap down? Is there an oversold, oh my goodness, let's go gap fill, and then maybe we'll try for a gap fill reversal from the sellers? No, it's a gap and go, momentum sellers. As we break down under Wednesday's low on Thursday, momentum sellers there. If we look at Friday, technically we're getting less and less in terms of the lower low on the bar-to-bar count, but really weak closes. We're not seeing any attempt from the buyers to step up right here, right now. If we think about the chunk of consolidation or value that we had referenced in the S&P underneath 547, we're already underneath. We're trading into that equal low. So my take here is that it wouldn't be unreasonable for a counter trend move first. You never want to be the sucker short dead on the lows of the move. Any lower high underneath 486.75 sets up the head and shoulders, and the deeper weekly pullback could be in store based on earnings as a catalyst as well as PCE as a catalyst this upcoming week. Another thing, just as we continue to reference what matters, notice the increase in volume down below. It's not like what we had seen in prior examples. Remember, this pullback back here really didn't yield the amount of volume that we saw in the Wednesday and Thursday sessions, at least, right? So the elevation of volume, the momentum that's coming in, it's worth making note that the market is changing its tone. It did not hold on to its key structure here. Let's jump on down to, well, firstly, this time we'll do it in the right order. Here is the trend channel out of the daily time frame chart. We have cracked the bottom end. So once again, just like you wouldn't really want to be pressing the bet to the long side when you're extended through the upper range of the trend channel, you don't really, on the first go at least, want to be pressing the bet to the downside under the bottom end of the trend channel. If this sets a lower high and then it's underneath again, that's a completely different story. The trend, of course, has already changed, right? So one step at a time there. Let's bring out the daily 20 SMA. We knew that we were already underneath on the Wednesday session, but just continuing to reinforce the idea that any sort of lower high attempts that reject that really keep the bears more so in control out of the daily time frame. Here's the hourly. We can all see, the same thing here. Highs, lows, tried for a higher low at least during this consolidation, but just smashed right out of the water. They hit it out of the park, those sellers, and they were able to, break right on through that 486.75. The beauty about looking at the hourly charts here is just to determine whether or not intraday there was any attempt for a buy-side reaction. The answer is absolutely not. As I zoom way in here, notice the second hourly bar of the Wednesday session actually rejects it as resistance. So to me, that sell-side momentum is in the market. It's starting to come through, and we can all acknowledge that this is an absolute cliff breaking down through that. It's the gap close below. So how do we trade this, right? This is starting to look like a sweep underneath on Friday. We looked underneath 475.35. If we can hold higher lows over, there's probably a nuanced level to include here at 476.85. If you could hold up over that for your Brigade bolt, it's at least a counter trend move to maybe set the lower high here or set the lower high here. And then from there, trading back down into the equal lows. If there's continuation, I would, this is your next most reasonable setup. Let this thing go, let the balloon float away, and we should use the red crayon for this. Let the balloon go, and then your short entry is on this dot, any lower high underneath the big flush point at, once again, 475.35. The buyers only have something going on, and we talked about this on the daily, if we were to get something that looks like this over the 486.76. So I think we've, beat the drum enough here on those scenarios. We're all set. Let's come in with the fibs from the top to the bottom of this move. 38.2 keeps bear flag consolidation in play, on any lower highs there, providing confluence off of this level, making sense. And what about the intraday anchored VWAPs? Let's have a look. For now, I would say that this lower high is maybe interesting. It's probably not a short off of it, at least for me. But then if we do come back down into the equal lows, that starts to suggest, okay, maybe the breakdown is after a lower high rejection. Again, you start to test that same area to the downside. This will be confluence as we get towards the sort of mid to later stages of this week, pending any market movement here. Let's jump on over to the NASDAQ internals, and you'll see a lot of similarities. So on Wednesday's gap down, substantial volume outflows, same thing on Thursday. Friday, of course, mild, but definitely out of the market, completely underneath the zero line, underneath trend lower zone on Thursday. The cumulative build speaks for itself on Thursday, building throughout the duration of the day. It's not a sort of liquidation break and a fade into the afternoon. Same indications as what we had in the S&P. So stronger sellers at the exchange level are starting to step up, and it's no longer just isolated to the Magnificent Seven, if you will. Quickly taking a look at the market profile for the NQ. Same concepts, however, we're already underneath those same concepts as the S&P, right? Here's a bulk of that value. Here's technically the top end of the multi-week balance range. There is your Wednesday rejection of that. Value area is here, value area is here, value area is here on the Friday session, completely underneath this long-standing chunk of balance from in the past. Do we have a poor low on the Friday session is the next key question to ask and see. I would say it's not technically a poor low, but it's lack of material excess down here. Also on Friday, it's really, buyers are unable to rotate into what I would just argue is thinner structure. It's not single prints like what we had in the S&P around D period, but you get the idea that rejection keeps you underneath halfback contained in value. Definitely more bearish progress in the downward direction, acknowledging that stronger sellers are coming out to play. And finally, the IWM Russell 2000 small caps on the weekly time frame chart. What do we see in terms of candle structure and location? I feel like I've been saying this for the past couple of weeks in a row, but one of these things continues to not be like the others. Nasty inverted hammer, huge upper wick that's easily got to be at least 4 to 5 times the size of the candle body. So what do we know took place? In the upper wick towards the highs, there is a pretty substantial pullback that accomplishes a close in the lower third of the weekly range, but we do still have a green-bodied bar, so there was no test or breakdown through the opening print for range expansion in the downward direction. It's basically not as bad as it could have been. I think it's also worth reinforcing the fact that to produce such a substantial upper wick in the first place, earlier on in the week, there was a sizable breakout, which we'll talk about on the daily in just a moment. In terms of the bar-to-bar count, we do have ourselves a massive higher low as well as a massive higher high, and we've closed outside of the previous week's range in the upward direction, even though it's by a thin margin here. So I really make the argument that the weekly chart remains bullish here with the caveat it needs to stay over the top end of this balance range below. So a mild pullback could continue into about 210. That would make sense from a technical point of view. Then we'll start trading or looking for targets back into the equal highs here, beyond that 233, and then the all-time high. So 210 checks out because we can all see the balance range here, but I also want to tie in the fundamental narrative. We know that small caps are always more rate sensitive, and we know that this breakout was driven by basically the beat in CPI meant that the odds of a rate cut increased, and therefore the operating conditions for small caps would improve, right? So if we can hold 210, great, the story doesn't really change, no need to adjust. But if we fail under 210, come back down aggressively inside of this balance range, and here's the caveat, a couple of other things also need to take place, and the NASDAQ remains weak, and the forecast is still for a rate cut come September, then oh boy, what is that starting to suggest, right? We know that small caps are always more sensitive to the economic situation. I would start thinking about the lack of growth, aka that dirty R word, recession. Now, again, not doom and gloom. I'm not like, oh my God, markets are going to fall out of the sky. But it's just something to think about as an indication from small caps if the technical structure does not hold and we see those other components that we've just outlined. So 210 holds a lot of weight here on the weekly time frame. If we were to come in with a Fibonacci from the bottom of the ignition bar, if you will, all the way up to this most recent high, we've closed right at the 38.2 retracement. That is at 216.75, give or take. We'll take a look on the daily chart as well in just a moment. And I do want to give you some additional context here with something like a 5-year chart. We know that the cluster of anchored view apps are all way down here. We don't need that, but what we do need is the volume profile on the weekly, because the upper wick did reject the highest volume node, kind of like the midpoint of this previous balance before setting the all-time high in small caps. And as of right now, the pullback has brought us down towards the bottom end of the high volume node. We're not yet in the low volume void, which basically is 210. So if we can hold 210, if we can hold up outside of and not fall back down into the higher volume node below, aka the balance range, right? I would still consider this a successful breakout. If the market rotates back within, that's where that dirty R word starts to become more so top of mind. Let's bring this back down to a daily time frame chart. Let's evaluate the expected move first, then we'll talk about the technical structure. So we've got ourselves the upper bound at 222.15. If held, that of course would imply a lower high. If we're contained by the lower bound, the number is at 211.50, implying a pretty big time higher low, as well as sustaining support over 210. If you want to be technical, the level is 209.75. So I like the lower bound here. It's also a gap fill reversal potentially off of the Friday gap up from the previous week's session, not last week, the week prior to that. So liking the expected move, it strikes me as being more so bullish than bearish, staying over 210. If we're thinking about the technical structure though, I mean, certainly have to give some credit where credit is due. Is a pretty harsh and severe pullback into the end of the week here, namely on the Thursday session after it rejected the Tuesday high of day. So Wednesday's fine, and look above and fail, we close underneath. But on the Thursday session, when we open at the low of the Wednesday bar rally, let's actually just take it directly down to the hourly chart. I think that this story is worth telling yourself, right? So here's your inverted hammer on the Wednesday session, and here is the Thursday open underneath the low. So put yourself in the shoes of a seller. If you're a seller out of small caps, why don't you just go gap fill reversal and sell this thing off hard? The fact that the market tried to break into the Wednesday range and rejects again at the Tuesday high of day is actually more so an indication of a failure from the buyers to produce ideal consolidation up here. So the change in tone is somewhat noteworthy, and you could probably argue that this just turns into a double top whatever, and we're underneath the neckline on this pullback. That's fine. So as we walk forward this week, what's the name of the game? Any consolidation underneath 218, I would probably be looking for continued pullback into the bottom end to close this gap maybe, and trying to see if we can find weekly support over 210, as we've just described. Any sort of inverted head and shoulders down here, any sort of double bottoms down here, a daily hammer candle that's produced would work down here. Those indications fly around 210. Now, what's the more optimistic take? Any sort of higher low for a hourly Brigade bolt over 218, and I think that this is easily a retest to the neckline up here, especially if the fundamental news this week, you'll see that we have PMIs that are slated to come out. PCE comes out on Friday, of course, and the initial jobless claims is always on Thursday. If that stuff is still within, sort of the bounds of, all right, we're not headed towards a recession, if the PMIs are suggestive of expansion, right, then, hey, maybe we're here and we're doing all right. This is consolidation up towards the highs from a weekly perspective, trying to digest the major breakout, which is this move from back here. Once again, if we just throw a Fibonacci on this thing, what you'll notice is that let's come in from the very lows, right, all the way up to these highs. This is the 38.2. Is any consolidation up here, even if it's a lower high retest, is still bullish from point A up to point B when we're using that as context, right? Let's bring out the intraday anchored view app, see if we're getting anything off of this. Not much, maybe some support over the top end of the gap, and over time, this is going to start providing confluence. It could be midweek with something like that 209.75, so I like that. Then the final fib I actually want to take as well is from that look above and fail on Wednesday down to the low. 61.8 is here at that 222.50 towards the upper bound of the weekly expected move. So if there is this rally, makes a lot of sense to me that this is going to act as a potential target, and we could see some hang up there as resistance. Let's move on down to the market internals, for the Russell side of things. You'll notice strong volume outflows on Thursday. The Wednesday look above and fail, even as it's making that higher high in the morning session, the volume flows are out of the market. As you look at Wednesday's open from the advanced decline line perspective, it's technically really weak off of the open. It sustains weakness on Thursday and Friday, and the cumulative ticks as well, weak, even weaker, and weak as well on Friday here. So I think it speaks for itself. I think that at the exchange level, we're seeing this change in tone. We're seeing this sentiment shift from the market. Let's finish up the Russell specifically with the market profile, and this is a great learning lesson. I wouldn't say that there's a market profile nuance in play here, but so this is the Tuesday rally to the upside. Here is the Wednesday value area and point of control, right? So the fact that value could not migrate higher over the top end of the Tuesday range, the fact that the point of control was not over the halfback of the day's range, to me, that's a huge indication that this pullback on Thursday, I don't want to say it was like guaranteed to be right around the corner, but it certainly doesn't have me feeling good about chasing new money longs at the highest high in the trend count. So overall, I think the Russell has been a huge help for trying to determine confidence in the S&P 500, and I would really urge you to continue using it as we move into this upcoming week. If we're going for the Brigade Bolt, if this is more so a consolidation effort, I would really be a fan of the higher low out of the S&P. If this breaks down to close some gaps, if it starts testing 210 and it looks really shaky, probably not a big fan of looking for your higher lows out of the S&P 500. Let's continue to get granular in the S&P by evaluating the performance of our sectors here. Notice that energy leads the pack up 1.33%, followed by real estate and consumer staples. All three of those sectors are lighter weight sectors for the S&P. At the bottom end of the barrel, it's the semiconductors ETF, down over 10% on the week. That's pretty substantial. For the S&P sectors, it's the technology sector, down over 6%, severe. This is the heaviest weight risk on sector for the market. And then it's consumer discretionary, down just shy of 2.5% on the week, another heavier weight risk on style sector. So is the posture really all that concerning as the market's actually pulling back? To me, the answer is absolutely not. If the market was breaking out to brand new all-time highs and the sector performance looked like this, huge red flag. We're actively looking for shorts as we're pushing to new highs, right? The divergence would be too severe to sustain for a long period of time. But as of right now, I take the approach where, hey, we're still seeing somewhat of a rotational market. Financials were up 0.75 of a percentage point on the week. Hey, what if semiconductors even just see a counter trend move into the early stages of next week? It probably means that the S&P starts to hold this 549.50. Now, I do have some concerns with some look above and fail, so let's start looking through the structural charts and evaluate what's going on here. Out of energy, we're starting to see a potential Brigade Bolt up and over 91.75. We know that crude has been higher recently. It's sustaining higher prices, so wouldn't be shocked to see this hold over the neckline in here. Let's take a look at real estate. It's a very lightweight sector for the market, but we're always reading into it a little bit more so when it makes a big new pivot high. It certainly did into the end of last week, and there's plenty of opportunity here for a higher low. Again, checks out being more interest rate sensitive, considering what's going on with inflation and the Fed. So that's bullish, right? XLP is where we start talking about look above and fail. Notice that this is a balance range, look above and fail here, very similar to the small caps in terms of the bar-to-bar structure. But if this rotates to the bottom end of the range, yes, that's downward pressure, but what type of sector is the consumer staple sector? It's definitely more D for defensive. So can I envision a market next week where you're seeing a counter trend move higher out of semiconductors, out of the technology sector, and then something like the XLP sees a rotation to the bottom end of the range? Absolutely. Would that mean I'm bearish the S&P 500? Probably not. I would probably be neutral to bullish on the S&P under those circumstances. Next up is the financial sector, and this also looks fantastic to me. I mean, we've got this balance range, really aggressive breakout here, Monday, Tuesday, Wednesday, starting to pull back, plenty of opportunity for a higher low over 4250, rotates back in the upward direction. Even if it pokes below, a retest to the neckline of the inverted head and shoulders would strike me as being A-okay if it's confluence with the 50 SMA, that's 4175, still thinking about a possible higher low there. Next up are the industrials. What do we see? Look above and fail, very similar to that XLP. So look above and fail. If it rotates to the bottom, we better see the rotation into the semiconductors. So this is quite literally a price rotation. This rotation over here is a sector rotation that we're sort of alluding to, right? Next up, the technology ETF, sitting on the daily 50 SMA, sitting over this breakout point from in here, closed the gap from this previous sequence in the past. Is it possible that you see an oversold reaction off of this level or in this zone technically? Can you start to see the selling slow down into this zone? That's the question to ask and answer. To me, the answer would be yes. We're pulling back from the highest high in the sequence. Now, I don't want to ignore the fact that we flushed under these equal lows. The gap and go would indicate that buyers didn't do their job. I'm not trying to cover any of that up. It's definitely starting to look more like a threat here, but even just for a counter trend move, it would seem likely that we could get something that does that, and then if we produce a lower high, now we're starting to talk about, okay, you've got a more severe indication of a daily reversal. We're just not all the way there yet, but it could be brewing. For now, giving the buyers the benefit of the doubt, looking for some congestion or some buy-side response off of this 217.65, just to sort of give you a line in the sand. If we're underneath, I'll raise my hand. I will certainly say, hey, we didn't get any sort of reaction off of that area. Probably going to start thinking about more bearish reactions from this market as a whole. Next up, consumer discretionary. What do we see? Flushing under the lows. What did we talk about on Wednesday? An opportunity for a higher low over 185.15 would strike me as being A-okay. That's a top watch early on in the week, noting that this is a heavier weight risk on sector. Great. Let it pull back a little bit further. It will look like red on the weekly performance if it pulls back first. But when and if you spot buyers here, that's constructive for the broad market as a whole. Semiconductors, shield your eyes. Here's the 10.25% move in the downward direction, fading off of these highs directly into these lows. So once again, as I'm evaluating this, yes, we've broken down underneath what could be construed as the neckline of a double top. It's definitely bearish if we get a lower high underneath that 255.70. I'm not trying to ignore or refute that fact. But if there's a counter trend move that gets you there, if there's a counter trend move that even just starts to test the bottom end of the gap, it probably spells, hey, we're not doing too bad in the S&P 500. You could probably look for that daily higher low to sustain. So these are top watches. Like, I think that if you're trading the index, the S&P, you have to be watching a couple of things: technology ETF, financials ETF, and the semiconductors ETF. I would probably throw into the mix the healthcare ETF. Let's get to that by moving through communications, and we'll see it in just a second. But what do we see here? Yes, more of a threat for some sort of reversal. I would start thinking about neutrality here. I wouldn't call yet for a big daily downtrend or a weekly downtrend, more so a balance range up here, chopping around, starting to figure out, okay, what are we going to do? Are we going to consolidate? Are we going to drop this breakout area a little bit more aggressively? We're not even there yet. Notice where we're trading, right? So bearish in the interim, but wouldn't be overly aggressive to the downside. Here's the healthcare sector, and this is a top watch because it is the third heaviest weight sector by market cap. Started to suggest a pretty impressive looking breakout, and now underneath that zone. We could probably split some hairs here and say that this should be treated as explicitly a zone and not just 148, starting to hold it on the lows of Thursday and Friday. So we'll give it the benefit of the doubt and say, all right, if we can hold up over 147.25, you guys know the rules up here in the penthouse, it's round numbers only. Let's grab that. If we can hold up over this zone, sure, we'll still be constructive on the breakout. But What is the healthcare sector? It's definitely more D for defensive, so carrying that forward into the narrative is probably worth, including, especially as we're evaluating semiconductors as well. Utilities, not much to talk about here. The midpoint of a balanced range, really lightweight sector, not going to move the needle. Same thing here out of the XLB. It's quite literally in the midpoint of its range. We did give credit where credit was due. This was a double top. We were underneath, no low or high, and you can clearly see back in the midpoint is probably at least neutral, if not bullish on the failed breakdown over here. And now we'll move on over to our ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This continues, to me, to suggest the bullish rotation remains the name of the game. So sure, the technology sector is taking a hit. We know that the semiconductors are really taking a beating, but financials have improved, the consumer discretionary sector has improved, and even though it's D for defensive, the healthcare sector has also improved. You're not going to have a market that's going to zero if that's the case out of these performances. You'll notice that we're not quite in risk off yet, and certainly not out of the XLU, so I'm not overly concerned about those indications off the lows. If we bring out the risk on versus off grid, there are some more severe reactions to the downside. We're no longer just holding up at sort of like equal lows or the opportunity for higher lows. This would be SHY over the XLK. This is XLU over the XLK. You can start to see how we're moving back down underneath this neckline. So some concerns are emerging, but it's really, if you isolate it to the technology side of things. For example, if I were to come in here, and we'll just do this as an active example together, you could probably imagine what the other ones would look like. Let's bring this to the financial sector, which performed quite well, right? And as we do something that looks like that, this is still constructive in building out its uptrend with the offering of a potential higher low. You could do the same thing with the SHY. You could do the same thing over here as well. So generally speaking, I still believe we're in a risk-on market, but right on the cusp there, really pending any either further weakness out of semiconductors or really the broader Russell 2000 as we've already run through as an example. Let's check in on the QQQ IWM. This is something that we had talked about in last week's episode on the not so ideal charts trading view. What do we have? Perfect retest to the top end of the breakout point here. And based on the conversations we've had so far, we noted that IWM on the weekly chart looks like it could pull back. It looks like it could retest that 210. And it looks like the QQQ, we want to avoid the sucker short at the bottom end of the balance range. Is it possible that this starts to see an uptick? If so, that's bullish for equities down below, still building the case for the market in the S&P side of things, at least, to be holding on by a little bit of a thread here. Let's move on over to our dollar. Let's get a little bit more fundamental with it. You'll notice that we're just in the midpoint of what I would argue is a really long-standing range from over here. More downward pressure is going to alleviate some pressure in equities here. It hasn't really been one-to-one over the last little bit. I think obviously interest rates are driving things more so. You could take a look at gold, which has sort of failed its breakout into the end of the week, coming back down underneath this area. It still could find a higher low, and I think if you want to use silver as a proxy just to sort of gauge the metals market a little bit further, you would want to see this area right here, right now, act as support at 29 if you're trying to maintain a bullish stance over in gold and a basically hard assets or a metals breakout. Next up, we can move on over to interest rates. Speaking of the devil, a little bit of an uptick into the end of last week, but nothing so severe where I would say, oh my goodness, Jerome Powell is suddenly considering, changing tone. No rate cuts anymore. We're actually going to give you a rate hike, right? Not the case. Plenty of opportunity for a weekly lower high underneath our major inflection point, which is 43.33 and the TNX 4.33 out of the 10-year yield itself. Let's jump on over to the inverted ZT to get a sense. So, small move higher over here does not strike me as the end of the world. I think that if anything, this downtrend continues to just reaffirm that based on the Fed tracker tool, let's jump on over here, this is probably correct. We're probably not seeing a cut for the month of July, but September seems to be priced in quite aggressively here. Some of the information that continues to validate this in my brain is not only Jerome Powell's commentary from last week on the Monday session. He said quite explicitly, hey, we're not going to wait until inflation hits 2% to start cutting. That's number one. We saw also into the end of this week that the unemployment claims did appear to be a little bit more so of a fluke than we would have liked on the big beat on not last week's session, but the week prior to that, right? Here's the orange forecast. There was the actual number. This time it was invert, right? So that inverse, was more so suggestive that the labor market is not necessarily safe here. And if we continue to have these higher interest rates, I think the market, and this is sort of some of the reasoning for that large pullback out of the IWM, that's my view at least, is that threat of, hey, people getting laid off, no spending. We go into a earnings recession, there's no growth, and IWM is not going to benefit even if there is some sort of rate cut environment. So that's kind of what this is telling me out of Thursday's numbers, really keeping a very close eye on the jobs market. Jerome Powell is likely going to try to save that. If we take a look over here, these are the initial jobless claims on a more long-standing graph. This is easier to understand, I would say. So this is a 4-week moving average of initial jobless claims versus continuous jobless claims. Notice that continuous is breaking out. So, again, evaluating what's happening with the labor market, not really moving in the right direction. I think this gets us to a rate cut faster as opposed to pushing it out further, but not really what we want to see. I mean, nobody's rooting for a recession here. Nobody's rooting for initial claims to continue to come in really weak. So watching out for that. Ideally, this starts to cool off as the market maybe starts pricing in more aggressively the odds of that cut for September. As we take a look at the earnings move here, I want to be very clear about the expectations as we're starting to think about Amazon, Google, Meta, NVDA, basically the Magnificent Seven, right? You can see that based on FactSet's research, and I can even zoom in on this, I should have done so prior too, but they're going to be responsible, or at least the forecast right now is saying that those 4 names should be responsible for about 56.4% of the earnings growth year over year. That is absolutely monstrous versus the 5.7, the other, you can see it down here, 496 companies in the S&P 500 are supposed to return. So the pressure's on. You've got to see substantial beats in all of these names, or at least the market's expectations are going to be let down severely, and that likely is what could bring in some larger concerns to the downside. So really thinking about that out of these names, if we scroll down, you'll also notice that Merrick Health is slated to really perform well here. And that's part of the healthcare sector. So it's a heavyweight component of the sector weightings, at least. We'll see if that continues to play nicely with the bullish narrative of rotation. It was just kind of funny to me that we have these Magnificent Seven names, and then we throw in Merrick Health, just kind of interesting. And then as we continue lower, you can sort of see the performance as we move into the end of this year. So huge performance Q1. We already know that we got that. Here's what we're expecting. And this is sort of how it continues to dwindle into the back half of the year. The commentary is that the smaller companies in the S&P are slated to improve. And why is this, right? Let's just think about the logical case for why that would happen, because rates are expected to come down, right? So the promise of rate cuts is really a driver right now for continuing to experience earnings growth in the actual ETF. I want to talk about financials because they started to report, obviously, not only last week, but the week prior. This is a snippet from Tom over at Walks in Wall Street's newsletter that he sends out every single Thursday. So if you're interested in this, you can go to his YouTube channel, you can sign up for his newsletter, but he does some great fundamental research. He's probably more tapped in fundamentally than we are, but I loved this segment that he put in here because you can see that Goldman just completed they ranked number 1 in worldwide of mergers and acquisitions year to date. What would that be indicative of? A lot of activity on Wall Street is probably more bullish for the economy as compared to like nothing's going on. There's no boom right now. Nobody's trying to get deals done. That would be an economy where I'd be more concerned about growth. So as we're sort of on this fundamental tangent, I like the note here from Goldman Sachs. You'll also notice that they increased their quarterly dividend, right? And their investment banking fees were substantially higher. You'll see the same thing if we scroll down with JP Morgan, right? Investment banking fees up 52%. Now, you can say what you want about investment banks, but this generally means that people are investing more money in those banks trying to look for a return on their money. There's activity in the financial markets, not so much a stagnation, which would be more indicative of that dirty R word, recession, right? So that is a nice note here from Tom. Huge shout out to, again, Tom over at Walks and Wall Street. I'll probably have a graphic up on the screen now of his channel. And we'll finish it up with the upcoming earnings. What do we see this week? It's a loaded week. We're starting to get into the meat and potatoes of it, if you will. NXPI is probably worth a watch on Monday after the close. That's part of the semiconductor space. We can watch for UPS on Tuesday before the open. That'll be interesting because they always have some decent insights in terms of shipping and what that means for the global economy right now. Tesla and Google after the close on Tuesday. Really important. Visa as well for our XLF. I will be watching those names in particular. The world's most expensive burrito is no longer as expensive. 50-to-1 split is through. IBM, the dinosaur of the tech sector, perhaps might be worth a watch. AbbVie from a healthcare perspective here. That really winds it down for this week. Into the following week, we know it's just going to be right back to the grindstone with your heavy hitters. I don't know exactly what the lineup is, but a lot of the other Fangman companies, Magnificent Seven, if you will. So that's the watch here out of earnings. Let's get back on over to the platform and finish up our risk appetite indications, jumping on over to, so this has really not gone anywhere. We don't need the TLT ratioed, but the bonds relative to themselves, notice that the short term is more aggressively in a downtrend than the longer term. This to me is just totally, it's reflective of the market pricing in, hey, we're likely going to get short-term rate cuts, but we're probably not dropping the longer run rate to like ZIRP, right? Zero interest rate policy, not going to happen. And that's what this would indicate down here. So overall, the preference is still for longer dated assets as this continues to drift in the downward direction and everybody is highly anticipating this cut. Credit spreads have not done anything impressive. They're starting to creep higher here, but also lower here. Until these things are both breaking out in sync to the upside, that's where I'd be concerned. We're not there yet. What about the HYG in isolation? The divergence has sort of run its course in terms of now we have highs and higher highs, highs and sort of higher highs, and we're pulling back as well. So you'll notice that the pullback, right, on an equivalent basis would be back to here in the S&P, whereas the HYG is not even close. So as this continues to play out, I'd love to see if the HYG could hold up higher than a full retest of this area. If this just turns around and prints a higher high, that would be a bullish risk on indication I would pay attention to early on in the week in the S&P, especially if something like your SMH is seeing an oversold reaction in the upward direction. So pairing these things together is really where they're most informative and influential. Let's take a look at Bitcoin, and this of course is giving us that inverted head and shoulders. We talked about this on Wednesday, starting to break out into the Friday afternoon there. Would really just be looking for the top end of the range on a look below and fail. So bullish there is probably more of a risk on indication, new highs versus lows. Aggressively rolled over into the end of this week, but I want to be very clear about the rollover. So let's go to a daily chart. Earlier on in the week, as we were pressing those new all-time highs, this was substantially improved off of this consolidation down on the lows. Now, it is important where we've ended the week here towards the zero line. It's not fine and dandy. I wouldn't say that, oh my goodness, this market's all good. It's not as much of a rotation that we were dealing with as the grind was continuing in the upward direction, perhaps maybe anywhere between 4 to 2 weeks ago instead of literally last week where there was some more severe selling at the exchange level. As we bring it on down to the SPXA 200R, we're still seeing that longer run moving averages are being held. Notice we're over the 50% mark versus a little bit more volatility out of the SPXA 50R. I do like the higher high that was produced over here. That is constructive in my view. Any higher low would just be an indication that this pullback gets bought up and not so much sold into for continuation to the downside. Let's take a look at the RSP. A little bit of a look above, and fail indication on this, but really just watching the top end of the range. So, the S&P cash index is already testing the top end of the range. I would watch to see, okay, if this goes sideways and this comes in a bit, do we support over 166.25? If we can stay outside of this balance to the upside, that would be incredibly bullish for the market in terms of the broadening nature of the rally we've experienced so far. QQQE is not quite the same. These two white lines on an equivalent basis are the same. Notice that the equal weight is underneath. So any sort of lower highs that sustain pressure down here, probably looking for some more struggle out of the tech side of the marketplace. And then we'll finish it up with the VIX. VIX is accelerating, not much of a shock considering that this is some of the more severe selling we've seen in a little while. So over the 15 handle, this is where we want to be prepared with wider ranges. So, you literally have to adjust your expectations of the market and how you trade when you're over that 15 handle. And the same thing takes place over the 2050 handle. So one at a time, but as of right now, expect wider ranges on the actual underlyings that you're trading, as well as in the VVIX. You'll notice that we're up towards that 103. It tends to act as I don't want to say the exact top, but unless something detrimental is going to happen out of the market, this is typically where we see this stall out. So that would be a top watch into sort of like the midpoint of this week. If we start to see a rotation higher, does this collapse and go to 75, or does it remain elevated? If it remains elevated, buckle up. The market's pricing in some continued volatility through earnings season likely, and it's not just going to be fine and dandy here for continuation with ease. Let's take a look at the vol futures. They are working their way towards backwardation, but still well over the zero line, so not concerned out of that. Same thing out of the monthly versus the 9-day, and the single-day VIX is just hardly at that inflection point, 1275. If it gets above, that's where we start to say, again, mind your ranges, but as of right now, nothing so detrimental where, oh my goodness, duck and cover markets are going to zero. Let's check in on the core list of companies. Let's get the job done here. What do we see out of Microsoft? So this is where I want you to be prepared for thinking about counter trend moves. Can we spot counter trend moves, and what does that mean for the S&P 500? So from top to bottom of this move, pretty severe pullback, definitely an opportunity for a weekly higher low over this breakout point. I would say that the daily higher low ideally would have been up here. That has been lost. So the daily trend will flip to down. It already is down actually with lows and lower lows, but the lower high could be a gap fill reversal. So I'd be mindful of that. How do you actually achieve that? Let's go on down to the hourly here. This is starting to look like inverted head and shoulders. I would say that any open in this range is consolidation. This Brigade bolt gets us for a gap close, and then we want to be thinking about daily lower highs up against 446.75, right? That's the gap fill reversal. From there, equal low is the target. Any consolidation that just continues to break down becomes a little bit more concerning, noting that the market's not seeing any counter trend rotations whatsoever. Next large downside target would be here, if not these hammers where the breakout stemmed from, the last weekly higher low at 416. So don't want to be doom and gloom. As of right now, the structure's not, I wouldn't say it's great. Notice that we are at the daily 50 SMA. It'd be ideal, in my view, to see this counter trend move and then reevaluate from there. Next up, we've got Apple. This one is looking much better than Microsoft in the sense that you can get a daily higher low out of Apple anywhere over 219. So this pullback can sustain itself. We do have a bearish 3-bar play on the daily here. Any breakdowns underneath 224, the door is wide open into 219. Here it is on the hourly chart. Now that we can see this, right? This is your little head and shoulders. This is your bear flag consolidation. Break these lows. There's the deeper pullback through some thin structure. If the market's going to improve here, I would really want to see, this one's tough because in theory, you would want the thin structure retracement over these range highs, but notice on the Friday morning session, you already attempted it and there was a clear, sell side reaction. So it becomes a little bit more difficult to say that you've got like a Stevie Wonder or a quick trade off the gates. So 225.15 could be a watch, but I'm not sure I would put all my eggs in one basket. I would prefer to see, instead of just a break here, a higher low above gets me interested for that stronger move to test 228.50. So wait for the requirement on this one. The first failure means that you need second confirmation on the next go around. Next up, we've got NVIDIA, the one stock to rule them all. What do we see out of NVDA? Double top, I think, is about as obvious as it gets on the daily time frame chart. Multi-day range on the sort of end of week, Wednesday, Thursday, Friday. Daily 50 SMA trying to provide support. So a couple of things to watch for. I would be more inclined to be bearish here as compared to bullish. Reason being is that the lower high is already in play. And you had an indication of a hammer off the 50 on the Thursday session. Notice that on Friday, we'll take it down to the hourly now that we understand this. On Friday, we opened here, tested that area, and buyers were not even able to step up over the hammer high just to close the gap. Like even if it was a gap fill reversal back down to the lows, bears still technically win that, but there's just no buyers interested in NVIDIA at this point based on this multi-day range. If anything, this actually on the hourly chart and this big flush point reminds me of Metaverse, which we'll get to in just a moment. So thinking about the flush, thinking about rotations, we've got 115.25, 110.15. If there is a gap close, great. I mean, we'll take this as a trade, but I'm very open-minded to just another lower high here to keep the daily trend down, something that looks like this. The gap fill reversal is 124.55. Next up, Google. We know that they are reporting earnings on Tuesday, so please be aware of that. Big retest area over here. Let's go to the daily so we can see that first and foremost. Big retest, bearish inside 3-bar play on the Friday session. Daily 50 SMA is mixed with us there. 178.25 is the key watch. Based on the 3-bar play, based on the Friday rejection of the Wednesday low, I would be thinking that it's sort of more of a short than a long. Unfortunately, though, it's on the lowest low of its pullback right now, and that's the sucker short. So the chart structure is not at all bullish, but I don't know that I could really stomach a new money long smack on the lows here. My preference would be, if we go to the hourly time frame chart again, now that we understand the structure, some sort of reaction off of this area. And again, keep in mind earnings on Tuesday are just going to blow this analysis out of the water anyways. But any consolidation here on Monday, in theory, would just set a bear flag. And once the consolidation was in force, that's where I'd look for the breakdown. So take that with a grain of salt. Earnings on Tuesday after the close. We're moving on for that. It's not really worth spending much more time on. Amazon, let's go to the daily. Earnings not an issue for this one. So 100% retracement, round trip has been accomplished. Counter trend move seems reasonable to me here. I would look for this. That would be the area to watch for at 188.25. Let's take it on down to the hourly. And how do we get there, right? So this, just like your, Microsoft perhaps, starts to look like an inverted head and shoulders over your neckline, thin structure retracement, and then boom, we're at the daily 50 SMA, 188.25. That's the upside watch. Anything that just consolidates without a break, it's not a long. It's as simple as that, right? Anything that's in here builds out a multi-day bear flag, and then beyond that, really just looking for the bottom end of the range overall. So one step at a time. And I want to reinforce the idea too that this is a huge failed breakout at this point. It's not like we undercut the breakout area and then popped back above for a Brigade bolt over 191. This is a pretty severe failed break now with a lot of overhead supply. I think people are going to sort of chill out ahead of earnings on this one, especially back down towards the congestion of the market here out of Amazon. Next up is Metaverse, and I want you to just think about what this looks like, right? We just talked about NVIDIA. Look at the mirror image, your multi-day consolidation. If we can break the lows, sort of thinking about continuation in the downward direction out of NVDA. So that's Meta, obviously, in hindsight, off of this move here. But what do we have looking forward? This was a big failed move on Friday also. This was an inside hammer. If you think about what the daily structure would have looked like on Thursday, this is the daily bar that prints. This is Friday, starting to get above. No dice on the hold over that 2-day high, 1 and 2 in here at 479.25. So I would be thinking about a look above and fail. Any acceptance under 479.25, and really the bottom end of the range is the target. 462 comes into our crosshairs, right? And that would be a rotation of this range as well. There's your inverted hammer on the daily, rejecting the 50 SMA, staying underneath this flush point. It's looking like a lower high, equal low is the target. Next up, we've got Tesla earnings on Tuesday. So be prepared and also just sort of beware. So take this analysis with a grain of salt. This consolidation is still technically bullish in the grand scheme of this move, but is this a high? Is this a set of lower highs? Yes. Are these equal lows? Yes. If this breaks, do we have thin structure? Yes. So I could see the opportunity for a downside move here out of Tesla. Even if it were to spot something like a weekly higher low, that's fine. Let's not lie to ourselves. Big time, weekly, monthly higher low, whatever you want to call it. There's plenty of opportunity for that off of the highest high in the trend count currently, even if it were to come all the way back down to something like the moving average cluster or the top end of the breakout range, 190s, 180s. That would be, in theory, right, structurally, quote, fine. But certainly earnings are going to throw a wrench in this. So my initial take would be for Monday, probably just watching for an early morning trade, whatever sets up pre-market. Maybe there's a response to keep this neutral ahead of earnings. And then just it's a back burner until IV gets sucked out of it post-announcement on Tuesday. Next up, we've got JP Morgan. What's going on with the financial sector? We just talked about how we're sort of bullish financials, right? This is sitting towards a ideal daily higher low zone. We have 209.50. We didn't get the best daily bar close. The daily bar sort of looks like this if you were to superimpose. So it's technically a bearish 3-bar play that's set up. That would be the Thursday bar. But if we can hold up over 209.50, I think that this is the trade I would be very, very interested in. Can we get a breakout and higher low, Brigade bolt, if you will, over the Friday high 211.50 to retrace into 216? If that's the case, awesome. You could sort of think of this as a double bottom. You could think of the Brigade bolt. You could think of whatever you want to think of, but your daily higher low on the retest, breakout, retest, higher low, equal highs the target, right? There's your 216. So that's the top watch out of JP Morgan. If it's really going to fail, I need to see a lower high underneath that 209.50, right? It's got to be something that breaks here and then possibly sets up the rotation to the bottom end of the range at 204.25. We're just not there yet. And because of the strength we've seen relative to the broad market, or at least I should say the tech side of the market out of financials, not willing to throw in the towel yet. Next up is Netflix. What do we see out of the movie star? On Friday, they reported earnings, and it was all over the place, or it's technically Thursday after the close. So take a look at this chart. You tell me, is there anything overly attractive about what you're seeing here to the point where there's an obvious trade to unfold? I think not. On the daily time frame, we could just zoom back out. Maybe there's sort of Man Ray patterns brewing and some sort of neckline underneath the 628.30s mark could be interesting for further downside. I would argue that this is definitely a bearish engulfer. I think that the bears are building control. It's all about spotting sort of more tactful entry here out of Netflix now. Perhaps it's a lower high underneath 641.50 becomes interesting, but look at that volatility on Friday in the morning session. I would sort of give this thing a second to breathe, figure out what it wants to do, and if we can spot the structure, great, we'll participate. If it's just grinding around choppy in here, you're going to thank yourself for not getting involved in no man's land. Next up, AMD, before I get you your 2 trade ideas, and then we'll be on our way. Daily time frame chart first is already rotated through the bottom end of the balance range here underneath the daily 200 SMA as well. I start thinking about the sucker short and not wanting to be short dead on the lows. And that was even the take as soon as the day closed on Thursday. So it just boils down to a risk-reward parameter. Like, do you want to be a new money short here after this really aggressive breakdown? Personally, I wouldn't want to be. So a lower high that gets set is most attractive to me. And where that happens is sort of yet to be determined. I mean, in a picture-perfect world, bears would keep it underneath the bottom end of the range here at 157. So any lower highs then bring in your downside rotation. But even if it's back in range, I mean, this is just a massive lower high from here to here, right? So really thinking about the bearish opportunities out of AMD to set up. And as of right now, if you're looking for this counter trend move, I would say that the Brigade bolt on a look below and fail of this balance range needs to be a higher low over 157 if you're going to look for the rotation to the top end at 165.50. Here it is on the hourly. You can see the obvious change in tone based on the nature of the type of sellers we have intraday. Very emotional, very, stronger sellers really pushing the bet to the downside there, panicking out of things. Would not want to be late to the party short here. That's AMD, and that is the core list of companies. Let's take a look at the first trade idea, which is UNH, United Healthcare. We had already talked about, the XLV as a sector, possibly setting up a look above and fail. This has back-to-back equal lows, almost similar to the IWM Russell 2000 small caps, with the inverted hammer on Thursday looking over the high of Wednesday, rejecting below that on Friday, setting up the two equal lows. It's thin structure to the downside, so underneath 562.50 looks like a short to me out of UNH for like some sort of retest of this breakout point, which is closer to 545. Let's go 65 on that one. You guys know the rules up here in the office. So that would be the downside. Something that looks like this is a possible scalp. Then we're reevaluating, right? I don't think you should overstay your welcome on the short side out of the healthcare sector, noting that not only did you break like a long-standing trend line a while back, but you're also over the pivot high. Right, so new higher high, you're pulling back from that location, looking for a higher low. Ultimately, you could even throw a Fibonacci on this thing from the bottom up to the most recent high, 38.2. Look at that. Literally, have some imagination, but you can't make this stuff up. There's your 38.2 directly on par with that breakout area we were just describing at 545.65. Let's move along to the second idea, which is going to be on Carvana. CVNA is the ticker there. Have not traded this in a very, very long time, but the setup really captured my attention. It's a bearish inside bar, obviously an inverted hammer, and I think that this could even just be a quick scalp. Underneath this 128.50 into the lows of this balance range from back here, if we had the right tool, I'd tell you what that number is. That's going to be around 122.25. So let's just call that loosely like a 6-point move in the downward direction. I think it's well within the realm of possibility, especially if the market starts seeing a little bit more sell-side pressure. If you look at the hourly time frame chart, another reason why it hit the radar and is such an impressive watch is because this is basically a textbook head and shoulders here. If you're underneath that neckline, I think that it's a very clear rotation into the bottom end of the prior support. Again, even if it's just a trade, so be it. I think there's some opportunity here. That's going to conclude today's episode of the Weekend Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live for the pre-market prep at 8 o'clock every single morning this upcoming week, possibly not Friday. We've got some very important music to be listening to that requires some travel, so we might not be around on Friday, but maybe we'll do a very early morning session just to get some analysis in there. Anyways, we hope to see you Monday. We'll be there, 8 o'clock, see you in the office, and with that said, have a green trading week.